Hi, everybody. This is Hyperwave. We have Socrates on today, which is going to be fun. Tyler, of course. And we're going to be seriously only trying to answer one question, which is the stock market bullish? I will stop right there. I'm also keeping the boys to 1 hour flat because I have bread in the oven. And I got to make sure that that doesn't burn. So first of all, Socrates, thanks for joining today.
My pleasure. Thank you very much for having me. It sounds like, are you learning how to cook some sourdough bread?
Attempting. Although I'm on like some baking spree, and Tyler's wife is teaching me. So it's going well so far. And Tyler, how are you? We are on our second vlog of the day.
Yeah, this is great. We'll try to keep it well short of an hour because we're only going to try to answer one question. Is the U.S. stock market bullish? And the answer is yes. So thank you for listening, and we will see you tomorrow. It's such a difficult question. It is such an important question. We have spent a year debating it. It has not been bullish for well over a year. It has not been bearish for well over a year. It's been going sideways. But the big thing for us all to think about today is, what do we mean by this U.S. stock market? And we're going to try an experiment today. We're not going to talk technical analysis in general. We're simply going to look at price. And everybody can draw their own conclusions. I'll tell you my conclusion. Socrates is going to jump in and give you his conclusions. I'd love to hear what Leah thinks after we look at some of these charts. But last week, a week ago, we said that this week coming up was going to be critical. It was going to be critical for a lot of different things, not Bitcoin. Nothing's critical for Bitcoin at this point. We all know where it's going, lower. But we're not sure about the U.S. stock market, the world economy, the U.S. economy, but everything seemed to be coming together this week. There was this push and pull that's been going on, and a lot of things might have been resolved yesterday with the Federal Reserve. We're not going to talk fundamentals. We're not going to talk about why is it bullish. We're just going to let the price tell us a story in the simplest terms possible. Now, this is not something I do and we do on our vlogs. We try to do all the peripheral things, meaning we've said it over and over again, the only thing that matters is price. When you take money out of cash in checking and savings or in a brokerage account sitting in cash, and you decide to put it into something, from that moment on, the only thing that matters is price. Everything else, all the reasons which are fundamental, all of the evidence which is technical, helps you to make decisions about what you're doing. But the only thing that matters is, if you bought something at $10, did it go up to $11 or down to $9? And that's all investing is about. Because if it starts going against what you thought, you want to get back into cash. And we've developed tools to help you to do that. We've developed very long-term tools to be able to tell what's the probability that this trend is going to continue. You made the right decision, you got in at the right time, or you got out at the right time, you've been sitting in cash, or you've been sitting in the asset. Now, the only thing that matters is the valuation of that thing you own. So when you're making a big decision, which this is very big, we were 100% out of the market in the second week of December. We took off inverse funds that put us 50% into the market, 50% in cash. And the question has been, since the second week in December, do we take some of that cash and put it back into the market, or do we take the half that we've got in the market and get out of it? So every day, that's the way my thinking is about subjects like this. And I came to the conclusion a week ago that this week we could see evidence that might help us to answer that question. Is it time to get 100% back into the stock market Or do we have some evidence that it is time to start paring back? Okay, so that's kind of the groundwork of what we're going to try to do here. I have no idea if we're going to be able to do it, but let's give it a shot. So I'm going to pull up a new chart that I built moments ago, which looks something like something. It looks something like something. Okay, I want to hide this. I'm going to go up here. And this is a chart of the S&P 500. This is a daily chart. And I've just drawn this little weird bridgey thing. And what this little weird bridgey thing is, this is an inverse head and shoulders as clear as you've ever seen one. This is a shoulder. Maybe this whole thing is a shoulder. I don't care. Maybe this is a double shoulder. I don't care. This is a shoulder. And I thought maybe we'd have a second one just because sometimes the market likes to be symmetrical. Very often it does not. I'm going to roll this out a little bit just to show that over these last 5 days, this week, remember I've been saying from last week, because we had 9s on sequential and we had 9s on weekly and daily on a bunch of different things, that it looks like it was all coming to a head this week. And this week, this is not a wick, by the way. This week on a daily basis, the last 5 days, this is today's big move with the S&P up 30 handles, 2854. I've been saying for a long time, 2850 was kind of a magic number for me. This is today's action. And you see what we've done is this is Wednesday, this is Tuesday, this is Monday, this is last Friday, and this is Thursday. So last week we began inching above this thing, but little tiny bitty bodies on all of these things. Very strange. No volume to them. What all that tells me is tremendous indecision. Then we pulled back. We pulled back yesterday after being down very big during the day, running up after the Fed made their announcement, and then we gave it up and closed down slightly, another little body. And then we've got this guy going on here today, which is why we're doing this vlog. I interpret what we are now looking at. If you measure the distance from the bottom of the head, this is the inverse head, up to the neckline, and it's a great neckline. I mean, it's how often do you see something this precise? 1, 2, 3 touches, 4, 5 touches, almost a touch. We'll give it 6, 7, 8, 9, 10, and then what appeared to be a breakout moved up 3 days, back down, and now has gone higher than any of the previous closes. That, to me, looks pretty darn good. So when you measure the distance between here and here, and you can break above that, you've got a target. And this target is just below 3,300, 3,279. That's a very nice move. We want to be in that move if it occurs. Okay, now I'm going to switch to the weekly. And all we're talking about is one little piece of the market. Here's the weekly. And I've been saying that we need to get into new high ground. We are not in new high ground, but we're not very far away from it. And this technical picture is now saying we've got a very good chance of doing that. And if we just get a little bit higher, up to around 2,950, we will have tops, above tops, above tops. And yes, we also have bottoms, below bottoms, below bottoms. which is also called a broadening top or a megaphone pattern. But I said I wasn't going to talk technical, so I will shut up about that. So here is the weekly chart, and we've had an incredible run up. Took us 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12 weeks back up to where we were before this huge drop, because basically of Fed policy, this huge run up basically because of Fed policy. And then we had some comments yesterday that lead people to believe, enough people that voted today by buying the S&P 500 to give us a strong technical daily and weekly candle. Now, this is not the end of the week. I do not like doing things on daily candles when we're talking about long-term trends. So my thinking at this point is, yes, this is a good start, but we've got tomorrow and Friday until 4 o'clock. And maybe something will occur tomorrow or Friday before 4 o'clock that will give me evidence to say it's time to get completely back in 100% into the S&P. Now, I will just pause there. I'm going to make a little aside, which is the S&P is not the stock market. That doesn't answer our question. Our question is the U.S. stock market bullish? My answer to is the S&P bullish, you have just heard me say, is yes. On a daily basis, the S&P is bullish. It is not yet on a weekly basis, but it could be 2 days from now. So I have just drawn a conclusion that this piece of the US stock market is bullish. And I am now going to get off of screen share, and so we can see Leah's beautiful mug and Socrates' ugly mug, and ask, what do you think about what I just said about the S&P 500?
Well, everything kind of run around in my mind has to do with the technicals, so I'm having to kind of bite my tongue there, since we're trying to stay away from that today. And I am pretty much inclined to agree with you with everything that you're saying, based on contingent on where the weekly candle closes. So I guess a quick question I would have for you is there a price that you need to see the weekly candle close above to remain with your bullish position, your bullish stance? If it does close below that neckline, for example, and I assume that you would be kind of changing your stance, what is that dollar figure there that's kind of the threshold for you?
Yeah, absolutely. The answer to that is yes, you're exactly right. What I'll be looking for in tomorrow and Friday is either a pullback to that neckline, which would be neutral for me. I would still be leaning bullish, but it would be neutral because we haven't really broken out and held it. So that means we've got to wait another week. So what I mean by that is that this entire activity is above that line. Now, you can draw the line a little bit differently and wiggle things around and all that, but I think I've got the line drawn pretty well as you get back, hitting this top wick, this top wick, this top wick. This is a beautiful example of what happens when you're right on a trend line, as is this one. This one peaked a little bit above it, and this one is completely above it. So far this week, this to me is a breakout. And that might mean 1 or 2 or 3 or 4 weeks up, and then a pullback. This is on the weekly basis. Let's take a look at the daily, because then we can zero in on price. And this price appears to be 2809, where the line is drawn. So I I would love to see a high above this tomorrow. I'd love to see a high above that on Friday. And on that basis alone, depending on what it looks like on the weekly basis, I'll make a decision on either going in Friday or waiting. Now, if it looks really bullish to me, but I don't pull a trigger on Friday, that does not mean I have to wait until next Friday to do it, because of everything I've just said, what the daily is saying. I always like some kind of a pullback on a significant breakout of a horizontal. I like to see a pullback before going higher. So that might mean what I'd do is I'd put half of X in and wait, and either put the other half of X in on an acceleration up, or the other half in when it comes back to the trend line. So that's kind of the way I'm thinking about that.
Awesome. And I guess if you want to just switch that over to the daily really quick, I'll make one quick comment and then ask one quick question not to get too in depth on the technicals or anything, but something that I really liked about the right shoulder of this pattern is that it pulled right back into the 50 and 200 EMAs right while they were making a golden cross. So that was the first kind of checkpoint for me.
Right down, right here.
Yep, that's exactly when the golden cross occurred.
Terrific.
And that was the first kind of checkpoint for me to say that, yep, we are turning back bullish. And then the second was breaking through this neckline. And I completely agree with you that I like to see the pullback retest the neckline. And that's kind of how I was viewing the action from the last 2 days. It's only on the daily and it's not weekly candles pulling back, but I really liked how we broke through. And then over the last 2 daily candles, not counting today, those 2 red ones, it seemed to pull back perfectly and catch support from that. So I would almost be afraid if it came back again, at least on the daily time frame. I'm viewing that as a successful throwback and don't really want to see another one.
Very good point. Very good point. And that's why it's so important to look at various time frames. And what Socrates just brought up is obviously what we will all do, each of you listening, but I will do, is before making that final decision, I will go crazy overlaying all the technicals on top of it just to make sure. And Socrates just pointed out an important one, running the EMAs. And what were the EMAs you were running there?
50 and 200.
Yeah, the 50 and 200. So that's big time stuff. We're not talking about, 7s and 15s and 3s like I do on the short term. Those are big time crossovers, and a golden cross under this pullback and supporting it is one fabulous indicator. So, okay. So now that's the S&P. S&P is not a little thing, but you've heard us say many times that it is controlled pretty much by very large cap stocks. And many of those large cap stocks are FANG type stocks or technology type stocks that happen to be very big in terms of market cap. And therefore they influence this. And that doesn't tell us what the US stock market's doing. It only tells us what this is doing. This being in the S&P. So now what we want to do is we'll look at the kissing cousin of the S&P, which is the NASDAQ.
Hey,
because
Kai?
Yes.
Can I ask you some questions on the S&P before we get on the NASDAQ?
Sure.
From my opinion, when we're talking about at least a bullish case, I mean, I think that what's pretty interesting, obviously, we have talked about it in yesterday. I think it was yesterday's vlog a bit more about Fed. But yeah, I believe what they're saying right now. Personally, I believe that support from the central banks usually means higher multiples for stocks. And I know we're not talking about fundamentals or TA so much, even though we have our nice charts up. But I do think, you know, pretty soon, I bet we'll talk a little bit more about fundamentals, and that obviously is important. But also, I was reading this morning that the S&P ETFs are seeing right now, I don't know if you've been following it, but the biggest inflows since the index hit the record high. I mean, just massive amounts, like something like 11 billion last week for the 3 biggest ETFs. And like, I think you could explain better, but I was reading that the term is that like this stampede from investors coincided with quadruple witching, right? So, and if I understand that correctly, that's like quadruple witching is like refers to a date on which like the futures or options or, you know, all expire simultaneously. So I think that there's something there that I would love if you could unpack a little if you think it's important. But usually, you know, I think events sequentially, well, actually, if Tone's even watching, he has his pie up these days of when he thinks that even with maybe lunar cycles and everything, things are going to be happening. And last comment I'll make, because I know that you remember everything, is I wonder, and this is the main question I have for you, given historicity and the fact that even the webinar we have this weekend is you're going to be looking at the biggest hyperwaves that you believe are the most important throughout history. Now, with what we've seen, with how the stock market's been reacting, you know how it played out in December. The question is, do you think that, you know, the S&P, the stock market's fourth quarter crash and comeback kind of can be seen as a comparison on Wall Street to 87 and 95, and especially given just that how the Fed, you know, had reacted during the October 87 crash. It didn't lead to a recession. The Fed reversed course to ease the policy, and then stocks recovered right through 88. But there was like a brief recession approaching in the 90s. But I just feel like, you know, again, like we had post-tax cut surge to an overvaluation condition last year that we were talking about all the time, you know, then fourth quarter crash. And that was amid when we had all the Fed FUD around it tightening. We had all the trade war with China frictions, and that actually, you know, was a really big deal. I would even compare that to now of the fact that those are easing, and that could potentially also be leading to this potential rally. But again, you know, exacerbated, you know, if we're going back to the fourth quarter crashing, exacerbated along the way by, you know, short-term volatility strategies in February. At one point, I had mentioned that I love following Third Point, right? They were starting to take a lot of short positions. So were a lot of different hedge funds, and really what they were doing. But then back in December was just a lot of, well, actually last February as well, is a lot of liquidations, right? So that scared everybody. But I guess the overall question here is just, do you see any similarities in historicity of what happened with 87 and 95 and the fact that it didn't lead to this massive recession and craziness then, and this may not now either? Long-winded.
Yeah, the short answer is, yeah, there are a number of similarities, and we are going to get into all of those details when looking at the 5 hyperwaves. The 1987 hyperwave in the Dow, the 1989 hyperwave in the Japanese stock market, the 2000 hyperwave in the .com, the 2007, 8, 9 hyperwave in mortgages and interest rates, and the stock market, and Bitcoin. We're going to look at those 5 from the point of view of all the fundamentals and the technicals that I considered as we were going on the upside of each of them and as we were coming on the downside, and what to actually do about it from a trading point of view. Not trading meaning jumping in and out, but trading meaning taking advantage of the direction of the major trends by being either in or out, when, why, where, and how. So we're going to do all of that. And just a real quick aside, all of a sudden we've got a lot of people signing up, and I'm very thankful for that, for this webinar, because we're encouraging people that have not listened to any previous Hyperwave webinars or workshops. You are perfectly okay to join us you will not be left behind. We are going into a lot of depth, but it's going to be on all of those topics that Leah just said, but practically speaking. And that's what you need today because of the conclusions that we're beginning to draw on this US stock market, on the gold market, on the dollar, on interest rates, on currencies. A lot of these things are being affected by all of these hyperwaves that are going on. And that's really the essence of it. It's not going to teach you hyperwave. It's going to assume that you assume there is such thing as a hyperwave. We will do a brief overview, but then we're going to get into the practicalities. What are the similarities between those 5 that I just mentioned? What are the dissimilarities, and what do they have to do with what we are talking about today, which is the US stock market? So that's a great question, Leah. And what I'm going to do now is I'm going to jump back, Jack. And I am going to go to the next chart, which is the NDX. I'm not going to do the Dow, which is what everyone runs to. And the reason is the Dow doesn't have all of these technology stocks in them that are influencing the S&P and the NASDAQ. Here you see a similar situation. You can draw a reverse head and shoulders here. We broke out on a daily basis a long time ago, 5 days ago. And so we've actually gone further on this because it's a purer form of what is the demand side of the overall stock market, meaning the S&P. It's coming from these things. All of these, or most of these, are also in the S&P 500, certainly all the biggest ones. Okay, so NASDAQ, so everything I said on the S&P, NASDAQ 100, the 100 biggest stocks in the NASDAQ, cool. All of that looks good too. So that gives us the S&P and the NASDAQ. Now let's go out to 2,000 NASDAQ stocks. You almost don't see any difference. This is the NASDAQ composite. Same chart as the NASDAQ 100. There's the NASDAQ 100. And there's the NASDAQ composite. So you can see that the calculation of indexes, it doesn't matter if you're talking about 100 stocks or 2,000 stocks, because they're cap weighted index, it's the biggest ones that are influencing the price. We're not going to go into individual stocks. We are going to look at sectors and industries because of what you're about to see. So now we've got 3 indexes. 2 of them are about the same. But let's now look at a very different index. This is the Russell 2000.
Can I make a quick comment on the NASDAQ in relation to the S&P?
Absolutely. Which one? The NASDAQ 100?
Yeah, that's the preferred, but like you said, both are very similar. So there's one thing that I was going to say is that if somebody's looking at longing the S&P 500 or the NASDAQ, if people are coming to the conclusion that the stock markets are bullish and they're wanting to put some money into work into an index potentially, I think that the NASDAQ is a much better option to long than the S&P. The S&P is still kind of struggling there through trying to work its way through the major resistance, and the NASDAQ has just shown a ton of strength, and it also doesn't necessarily have the same risk of the broadening top that could still be forming on the S&P. So this one for me is a lot more attractive to put some money to work at if you're just trying to decide between the 2 charts that we just looked at. And a quick question I had for you is, would you view this as a leading indicator? Are you expecting the stock market to follow in its footsteps here over the next couple of weeks?
Yeah, I am. But you also run the risk of this doing just the opposite. something happening, and all of a sudden the NASDAQ starts falling apart, and then you know the S&P is going to fall apart too. But yes, it is a leading indicator, has been all the way up, and on a relative basis, its constituents are doing better. We are very close. By the way, this measurement goes from 5,900 approximately to approximately 7180. Let's call it 72. So you can make your own projections about what this break means. It clearly takes out these tops, which will be very important, but then you're going to be way up here around 80, 59 to 72 is
85.
1,300. So 84, 8,500, somewhere up in this range is your target. Which is interesting depending on how quickly it gets there because of the slope of this, and is also very interesting because of hyperwave, which we're not going to talk about today because we're going to go into huge detail over the weekend about that. So yeah, good point. And here's the weekly.
And last thing before you go for the weekly.
Yeah.
Is, at least something interesting to note, obviously, is that Apple today and actually this whole week are supposed to release a competitor to Netflix, and there's just obviously any of the FANG stocks, but it'll be interesting for sure.
Yeah, very good. I just wanted to show the weekly on this NASDAQ because there are a lot of people that believe this was a fourth phase of a hyperwave, where this could be a 5 and this could be a 6. So one of the reasons I want to get above this is as soon as we're above this, then this is not a phase 4. And we will go into great detail about that for the Russell and other indexes and many, many, many stocks over this weekend. So please join us this weekend. And enough of the advertisements for now. You'll get one more right before we're finished. But okay, let's go down and take a look at the Dow Jones now. The Dow Jones has had a great run. It's got a similar kind of a pattern where you could draw inverse head and shoulders here because of this pullback. In fact, I think it's valid to do that. And it is occurring much closer to the tops that it had before than either the S&P or the NASDAQ, just in terms of just one big push up from here, and we are going to be breaking to the upside. One little push up from here, and we're going to break this neckline, which is around 26,000. Let's call it 25,962, where this blue line is, because it encapsulates these three weekly bars here, and also shows that we're struggling right at it right here. So on a weekly basis, too early, but I think it's important that the Dow is also in gear with what we've just looked at, the S&P, the NASDAQ, and the NASDAQ 100. Now, I did pull up the Russell 2000, but first I'm going to pull up the Dow Jones Transports. This is a problem. This is a problem because it is not acting as a chart the way the previous 4 that we just looked at is acting. Yeah, we've got a nice move here today, filling this gap from the previous 2 days, which occurred yesterday. But on a weekly basis, when I just look at this chart, I don't get the warm and fuzzies that I did looking at the Dow or the S&P or the NASDAQ. My eye quickly goes over here to this uptrend that was broken and then attempted to get back above that uptrend, whatever you want to call that uptrend, and then it collapsed. And not only did it collapse, but it took out all of these from the summer and the spring of 2017. And for Dow theory, here's the Dow Industrials. Here's the Dow transports. You can see the relative weakness. You've got tops below tops below tops. And when you look at the Dow, this action is above this last top. And this top isn't too much ahead of it. So there's a huge disparity. Now we know it's because of FedEx. We know it's because of Boeing. We know there's specific elements of this index that give us pause, but let's not make excuses. This is not in the same category as the previous 4 indexes. So all of a sudden, what we're beginning to see on daily and weekly basis is a market that's generally bullish and a market that needs a little bit of time to prove itself on the weekly basis, but is already giving us some evidence on a daily basis that it wants to go higher and maybe much higher. But this index does not do that. I will jump off again here unless you want me to look at any of those for any comments, anything you saw there?
Not as much. Just more of a question about the hierarchy of importance for that. How important is that to you? Seeing that Dow Jones and transports chart still looking very bearish with lows. It looks like right now it's just establishing a new lower high potentially, opposed to putting in any sort of bottoming action after that big kind of breakdown from the trend line. So if you see the S&P continue to look strong and that continue to look weak, how big of a problem is that for you? And at what point would you really start to become concerned about long exposure?
Well, I'm a big believer in the Dow theory. And the Dow theory says that US stock markets in general, even though there's only 30 stocks in the Dow, and I think there's 16 or 17 in the transport, maybe there's more than that now. It's a tiny number of stocks, but they tend to be very, very important stocks across all industries. And Dow is not calculated on a price or a cap weighted basis. It's calculated on a price weighted basis. So if you've got 1 or 2 or 3 stocks in all 10 industries, which the Dow tries to keep at all times, and you don't let any of them dominate the calculation of the index because it's based on price only and not mark cap, which is price times the capitalization of the company. It's a very clean index in terms of its signal about what the overall economy is doing, much more so than the S&P when it's dominated by a very small number of very large stocks. So if we are getting, or there's a possibility of a Dow sell signal here in the next weeks or months, which would occur if the Dow transports can't get back up and go to highs the way the Dow Industrials is trying to do right now, that is a non-confirmation, and the next downturn could be very, very severe, and very often could also signal a recession, which would call into question anything we've said about the NASDAQ and the S&P. So I don't think of it quite in the terms that if I've got a Dow theory sell signal and I've got bullish targets to the upside on these other things, which is more important, but I do look at both of them. And I might be much more cautious on my bullishness if that Dow theory sell signal is still sitting there. But that doesn't mean I won't be in the S&P and the NASDAQ. I just might not be in 100%. I might leave some cash on the table.
All right, you crazy gentlemen. We are going on 45 minutes. So I think that that's a really good ending note, Ty, unless you have a last thing to say.
Well, I want to look at, I will do this very quickly, and then I will give you the conclusion. My conclusion is we sit here this afternoon, and then I want to hear your guys' conclusions too. I am screen sharing, I think. Okay, here's what I'm going to do real quickly. I'm now going to break these indexes down into sectors. And we're not going to do a lot of talking about it. I'm just going to show you that when you break down indexes into sectors, they begin to tell you some interesting stories, because I did this earlier. First of all, we're going to take a look at the consumer goods. Not good. Highs below, highs below, highs below, highs. Yeah, it's had a nice little rally, but not good. Consumer services looks pretty darn good. You've got an inverse head and shoulders here. We've broken out above it. It looks like some of the big indexes we just looked at. So that's one bad, one good. Energy, caca. Yes, it's had a good bounce, but it looks terrible. One good, two bad. Financial services, not horrible, but everybody noted that the banks have gotten very weak because of what happened yesterday. They were weak yesterday. They were weak again today. We are at the lower end of this shoulder. If you want to look at this as an inverse head and shoulders, I would love to see this start showing some relative strength. Otherwise, I would put this at neutral relative to the other industries we're looking at. Healthcare, pretty darn good. We do have highs below highs. We have lows below lows, but it's struggling. I'd put this neutral if I'm just looking at the price. These are the industrials. They really looked horrible in the fall and into December, and they've come a long way back up. You don't have this shoulder action that occurred down here, so we've actually gotten above that. I would say that the industrials are looking positive. Utilities are the strongest of all. That's not necessarily a good sign, because when the industrials are leading on a relative basis to other sectors, it means that defensive money is moving into them, mainly for the yield and their stability. But you've got to say this is very bullish. I'm not keeping count of these. I lost count, but so far we're getting a very mixed picture. These are home builders. That's really an industry. We don't need to talk about that. Here's technology. Technology, again, didn't even pause the way the NASDAQ did. It's just gone straight up. We had 1 week down and then straight back up. Very, very bullish and very close to taking out the all-time highs in the sector. So I see a mixed picture on the internals of these indexes. And we can see that there's a very strong explanation of why some of the indexes are stronger than the others. It's because of one or two underlying sectors in the way they're calculated. But that doesn't mean that when I see something like an inverse head and shoulder breaking to the upside, that I won't put a large amount of X into that, just that one. I'll try to stay away from the other areas until they prove themselves. The transports, the banking sector, the energy sector. If they want to come along later, that's great. When they give me proof, then I can move some money into those. But that's no reason not to draw the conclusion that the S&P and the NASDAQ, which are inimitably investable, should not be invested in a large way if the next 2 days continues strong. And I will turn that over to you guys. Socrates, what do you think about all that?
Yeah, I'm pretty much seeing it the same way, where it's a pretty muddled picture, and in those scenarios, I either like to just stay out entirely, or I like to decrease position size. So a lot of times you hear Tyler say, put in percentage of X. Well, in a situation like this, I kind of like to divide X by 3 or 4 when I'm not very certain, and there's a lot of kind of moving pieces that could change very quickly. I'm of the opinion that it's a good time to decrease the size that X is, and then proceed accordingly. So for me, the first check mark was when we got the golden cross with the 50 and the 200 EMAs that came through about a couple weeks ago, and then the next check mark was what we're seeing right now, breaking through that neckline of the inverse head and shoulders. The third check mark would be basically creating a new all-time high and establishing that for more than just a day or two, at least a week, and probably a couple weeks. So for me, if we do establish a new all-time high, that's when I would want to have all of X entered, but keeping in mind that the X is significantly smaller than I would normally like to trade. So potentially down the road, if it really does establish a good trend after creating a new all-time high, then I might have a new X that I am looking to get entered on a throwback that tests the old all-time highs or something along those lines, maybe a TD sequential entry. So for now, I am definitely leaning on the cautious and conservative side, but am on the side of the fence with the bulls, thinking it's about 60-65% chance that this is going to really establish a new big bull run that could last for years. And if that does happen, then I am thinking that a phase 4 would be primed to take off. So it could, whichever way it moves, I think it's going to move in a big way. So now it's treading with caution, and we'll be ready to pull the trigger on some much bigger orders once there's more confirmation down the road.
That's great. And Leah, all the questions you asked about the fundamentals, the similarities between what we're seeing now compared to previous periods, similarities in what the Fed has done, similarities of an accommodative stance on their part. As you and I have talked about, one of the things we are going to accomplish on Saturday and Sunday is we've just been today flying at 10,000 feet, looking down at the ground, observing what we see. And on Saturday and Sunday, what we're going to do is we're going to drop down to about 500 feet, and we're going to come out with all of our weaponry blasting, all of the technicals, all of the fundamentals, all of the macro Fed in talking about previous hyperwaves at this point, where you're trying to decide, are all these things ready to break up? Are we really in 3s, or are we on 4s? Are there really some 5s that have occurred? Or are they simply pulled back to 3s? And we will go into great detail about that. Some people have been commenting that they did not want to participate because they thought this was going to be way over their heads relative to what they're trying to accomplish. They don't want to be traders. They don't care to learn about the technicals in the depth that we tend to go into them. But they are very interested in the idea that right here, right now, some very big things are happening that could influence their retirement accounts, their investment accounts, for not days or weeks to come, but months or years. That's the turning point I think we're at. And that's what we're going to go into in a lot of detail this weekend. So if you have not yet signed up, I want to make it really clear. Yeah, $1,000 is a lot of money. And if you haven't done any previous ones and you think you're not going to get enough out of this one because it's going to be too high level, I'm trying to persuade you that is not going to be the case. I'm hoping what you will do if you do join us and you are paying full freight of a $1,000 or 0.3 Bitcoins, you will quickly understand that it is far, far more valuable to your assets on a going forward basis from what you will learn from it. But more importantly, I'm hoping you'll say, okay, I think I see what they're talking about. I want to go back and look at the webinar that they had several weeks ago, or go back and get into more depth on Consensio. If anyone decides to do that, you will get a very big discount. I believe, Leah, that it's set at 50% if you go back and do any of the previous ones.
Sure.
Or is that right? So if somebody signs up for this one, has not done a previous one, if they have done a previous one, they're already going to get a big discount. But if they haven't done one and they decide after this one they want to go back and listen to another one, they would receive a discount on that one.
That has been aired live, so therefore that is correct, everybody.
Wonderful. Okay, that's great. And with that, thank you very much. Unless, Leah, you want to make any last comments about what Socrates said or what I said, or fill out a little bit more of where you were going with your thoughts.
Sure. I guess I find a couple things interesting and questionable. One thing that I've been questioning is, why is the Fed so dovish? I just think it's really interesting. I think it needs a little bit more thought and discussion around why. I get what's happening, but I want a little bit more into the minds of Powell. And a lot of people are throwing around different theories, but I do think that that's more of a discussion, and that's something I'm thinking about. Obviously, they said, Powell was saying that actually he's worried about the economy. People are talking about today, the spread between the 3-month and the 10-year Treasury, right, fell below 10 basis points for the first time since 2007. They're inverted. Now, if I remember correctly, Ty, you said you don't care about anything besides the 2 and 10.
Right. The 10. Well, I care about all of them, the entire curve, but the 10 and the 2 is the one that's predictive, the highest percentage probability of predicting a recession comes from the 10 and the 2. But about 40% of the curve at various points has been inverted, but it's almost always at the very short end, the 2 to the 3, the 30-day to the 2-year, not when you get longer out. And so that's interesting, but it isn't definitive.
Yeah, no, I completely agree. It's just there's a lot of FUD around it right now, and there are a lot of interesting and not good-looking, but also some good-looking econ factors. So the overall picture worldwide is just painting a lot of different things.
Well, absolutely. You read the papers today, and people all over the world are shocked at what happened yesterday because of the total capitulation of the Federal Reserve in terms of anything restrictive at all levels, all 4 things they talked about. And your question is why? And I think there's 4 answers to it that are fairly clear. Number 1 is, and they were mentioned by Powell in the question and answer series, but also by other analysts looking in. Number 1, he made it clear that the U.S. economy is growing slower than they thought it was, they, the Fed, and they lowered their GDP. Number 2, they are concerned about the tremendous weakness around the world, more so than they had expressed before. Number 3, I think that they felt that they screwed up by being inarticulate about what they were really talking about back in September and October that caused the markets worldwide, but particularly in the United States, to collapse. and everybody pointed their fingers at them, they. And what they decided to do is to ease out of that by first of all saying, look, we're going to be patient. We are not on autopilot. We're not going to automatically raise 3 times this year and next year. They backed that off. That was in December where we started this big rally. And then in the this last meeting, they became very clear in the opposite direction. Not only are we not going to be on autopilot, but we are going to another autopilot that says we are not going to raise in 2019. And 17 of our members voted that we will only have 1 increase in 2020. That's an enormous turnaround. So why did they do that? Well, one is because now they are saying they have achieved all the neutrality that they wanted. They are not accommodative and they're not restrictive. So stop pointing at us. It is not us anymore. But what they just did by being so accommodative is, first of all, they hurt the banks because the net interest margin is dropping rapidly since 2 o'clock yesterday afternoon, meaning the spread between what banks can borrow at and what they can lend at. And interest rates continue down today, and the dollar dove yesterday, which caused gold to spike up, oil to spike up, and other commodities. So yes, what they've done is they've set the plate for what the market today is interpreting as accommodation from the perspective that these guys aren't going to get in the way anymore. We don't have to worry about the next meeting them saying something. Now, what we have to consider in answering the question, is the stock market now bullish? Is those things they were worrying about, the real strength of the US economy and the real strength of the world economy. And I believe the stock market tends to be a leading indicator of those things. So if the market stalls out here between now and Friday, or doesn't really continue this spurt from the last couple of days into next week, the market is starting to show the same caution that Socrates just showed by us looking at what the market really is. It's not this index or this index. It's all these indexes plus all the sectors that make up those indexes. And all of a sudden, it's not as overwhelmingly bullish as just what the surface numbers look like on the S&P and on the NASDAQ and on the technology sector. So everything I'm saying is known to all parties out there that spend their time thinking about all this. And then they all vote. They all vote by buying or selling. Today they bought. Let's see if tomorrow they continue buying. If not, it could very easily run out of gas because the fundamental economic underpinnings, as we know, are dictated by this huge credit debt problem. And all we're doing is maneuvering around under that problem until some solution comes along. So great question. I think we better let everybody go to dinner. And thank you, Socrates. That was great.
Tyler.
And can't wait to see everybody on Saturday and Sunday. It's going to be a lot of fun.
Can I say something really quick?
Of course.
So I don't know if people who are watching know, but Tyler's former partner, I will not name names, is one of the biggest bond experts in the entire world. Tyler is an absolute genius on it. When I went for my Goldman Sachs interview, I was supposed to be a muni bond trader. Thank God I'm not doing that. I knew nothing about bonds. And Tyler explained for hours on end, and I absorbed hopefully some of it. Now, what is something that I'd like to discuss on air with you at some point is what I think also what's really interesting is just what we're seeing with bonds right now. And again, when we're talking about the Fed, right, I mean, there's it's an inverse relationship, if people know, between interest rates and bonds. But right now we're seeing stock stock rises and the bonds are rallying as well. And just so everyone knows, typically bond prices and stocks are also correlated to one another. But again, with what we're moving forward, what I found most interesting, if I understood it correctly with Powell, was, you know, yes, what we're talking about, but also that they're worried that we're actually not going to hit the 2% inflation target at all. That
Right.
even be zero. And for me, that's the most important thing that I heard, actually. Now, everybody in the crypto world, sorry guys, you think inflation is the worst thing in the world. It's not. It's a debatable topic, and we could go into the minutia of it. Deflation is much worse, but at the same time, you know, it's important to understand what inflation does, why we do it, and the importance of specifically why it's very dangerous that he's saying that potentially from 2 to 0. But again, you know, just what's interesting, because Tyler's an expert in gold. Obviously, we talk a lot about the gold standard when it was established with Bretton Woods in 1944, et cetera. If I remember my history correctly, and hopefully my degree, you know, back when the United States was still on the gold standard, monetary policy used the inflation rate targeting, I think even back then, of 2% to consist of simply just trying to control the exchange rate back then. But what is important right now is that the number serves more as an anchor for people. And the fundamental reasoning really is to provide public with a stable and predictable indicator of econ strength. Right. And so the Fed interprets in 2% as consistent with price stability. And they adopted that in like early 2012, something like that. But again, what's probably most important, again, is that at least in econ theory right now, whether you agree or disagree, is that inflation expectations are an important detriment of actual inflation. Right. We always talk about behavioral economics and behavioral finance and how, you know, the market cycles. We like bringing up the psychology chart. We explain how it's a bit different from Hyperwave. But I think that also, you know, that everyone should understand the importance of psychology and how that plays into actually what the Fed did, and that can't be understated. And if I can ask one last question to end on, which I think you'll have a little bit of fun with, Ty, and then let's finish. Or actually, I can stop right there if you'd like.
No, that's great. And you and I and Socrates will do a vlog, we promise, next week on bonds, interest rates, inflation, and debt in great detail because of what happened yesterday. You're exactly right, Leah. That's the underpinnings of all this. The short observation everybody must make is, if you accept our thesis about the big macro problem being debt, what is debt? Debt is represented by a piece of paper that's called a bond. The bond moves up and down because of a thing called interest rates. Interest rates move up and down because of a thing called inflation. Therefore, the heart of the problem of world macroeconomic debt is too much paper where there are two parties, a creditor and a debtor. And the debtor is in a position where they have to pay the creditor and can't. They've run out of money to pay even the interest, let alone the principal on that paper, which means the creditor is the one that's about to lose their heads. And that all shows up in the bond market, the mortgage market, the muni market, the sovereign debt market, the corporate bond market, in terms of the movement of the relative credits and therefore the relative interest rates. And we will go into all of that in great detail in probably a 2-hour vlog next week, I promise.
All right, my timer for my bread went off. So
no, you better, Lisa's going to kill you.
Lisa's going to kill me. So I think we're going to go. I will.
Okay, thanks.
I'll end on one thing, Ty, related to that, just so that we relate it down to trading and very practical levels, just so everybody knows, and I'll wrap it with a bow. Again, if we think that this dovishness is here to stay, and now is the shift in it, it's really important to understand when it comes to trading and investing, if this shift in macro monetary policy is actually priced into assets like risk on currencies, equities, commodities, other value assets, if there's issues with bad liquidity, what other fundamentals are leading to the swings that we've been looking at, and how, we want to, again, interpret what we're seeing, not just with econ, but specifically with, what's up with buyback, short covering, dealers gamma hedging, re-leveraging, all these different things, and how to play them. So I will end there. Socrates, thank you so much for joining us, and you are going to be integral at the webinar this weekend. It's going to be, I can't wait to see it.
Thank you very much for having me. The webinar is going to be very exciting. We've been preparing for it for weeks now, and it couldn't be a better time to be having it. Having it during market that's black and white doesn't leave a whole lot to be learned, whereas when you're doing it in a kind of muddied environment and walking through the intricacies there will be an ideal way to learn about the topics that Tyler is doing such a good job of teaching us. So thank you very much for having me on, and I will be looking forward to this weekend.
Okay, great. Thanks, everybody.
Bye, guys.
Bye-bye.